Welcome to Global Currents, where we dissect the profound shifts reshaping the world economy. Today, we delve into a financial phenomenon that has quietly exploded into a multi-trillion-dollar market, operating largely outside the traditional banking system. It is known as private credit, and its ascent is fundamentally altering how businesses are financed, risks are managed, and wealth is created, often far from the public eye. This shadow banking evolution, spurred by a decade of regulatory change and a relentless hunt for yield, poses complex questions for stability and transparency.
The numbers are staggering, painting a picture of relentless expansion and market penetration. Global private credit assets under management soared past $1.7 trillion in 2023, up from a mere $400 billion a decade ago. Projections suggest this market could comfortably exceed $3 trillion by 2028, reflecting a profound reallocation of institutional capital. Pension funds, sovereign wealth funds, and endowments are increasingly dedicating significant portions of their portfolios to this asset class, lured by its attractive risk-adjusted returns. We are observing institutional investors allocating up to 10–15% of their total portfolios to private credit strategies.
The genesis of this monumental shift can be traced directly back to the 2008 financial crisis and the subsequent regulatory crackdown on traditional banks. Legislation like the Dodd-Frank Act in the United States and global Basel III Accords mandated higher capital reserves and stricter lending standards for commercial banks. These new rules made it prohibitively expensive and risk-averse for banks to engage in certain types of lending, particularly leveraged finance for middle-market companies and complex structured deals. Consequently, a significant lending vacuum emerged, creating an opportune environment for non-bank lenders to step in and fill the void. Major investment banks, once dominant in these riskier loan segments, either curtailed their activities or spun off entire divisions.
For many small and medium-sized enterprises, accessing traditional bank loans has become an increasingly arduous and often frustrating process. The paperwork is endless, the approval times are lengthy, and the collateral requirements can be prohibitive for growing businesses lacking established credit histories. Private credit, by contrast, often promises a more streamlined, flexible, and responsive financing solution, appearing as a lifeline for companies unable to secure conventional bank funding. Consider a regional manufacturing firm needing quick capital for a new production line. A bank might take months, while a direct lender could close a deal in weeks. This speed and adaptability are significant selling points despite potentially higher interest rates.
So, billions of dollars, once channeled through established banking networks, now flow through a less regulated, less transparent system. This shift is not merely about alternative financing. It represents a re-engineering of the global capital markets. But what exactly drives this unprecedented migration of capital and risk into the private domain? What are the fundamental forces underpinning this silent revolution?
For corporate borrowers, especially in the mid-market and private equity-backed sectors, private credit offers unparalleled advantages beyond just speed. These lenders are known for providing bespoke financing solutions tailored precisely to a company's unique needs, unlike the more standardized products from traditional banks. This can involve complex debt structures for leveraged buyouts, acquisition financing, real estate developments, or even project finance in emerging markets. A private equity firm acquiring a niche software company might seek a senior secured unit-tranche facility from a private credit fund, blending senior and junior debt into a single, efficient package. This approach often comes with less restrictive covenants and more direct relationships with lenders, fostering greater operational flexibility for management.
The allure for institutional investors is equally compelling, particularly in an era characterized by persistently low, or at least historically moderate, interest rates over the last decade. Private credit typically offers a significant yield premium, often 200 to 500 basis points higher than comparable public market debt. This illiquidity premium compensates investors for the inability to easily buy or sell their positions on an open exchange, but it generates substantial income. Furthermore, private credit provides diversification from volatile public equity and bond markets, as its returns are often less correlated with broader economic cycles. Direct lending funds, business development companies, and distressed debt funds are common vehicles through which investors access this asset class. For example, a large public pension fund might allocate billions to a private debt fund specializing in European mid-market loans, seeking stable long-term cash flows that are less exposed to daily market swings.
This fundamental shift in corporate debt dynamics moves a substantial portion of the economy into less transparent waters. Companies that once might have pursued public bond issuances or even IPOs are now finding it easier and quicker to secure private financing. This affects transparency, as privately indebted companies face fewer disclosure requirements than publicly traded entities, limiting public accountability. Consider a high-growth technology startup that, instead of venturing into public markets, secures multiple rounds of private credit to fuel its expansion. While efficient for the company, this keeps its financials and operational risks largely opaque to the wider market and public.
This confluence of regulatory contraction, borrower demand, and investor appetite has engineered a seismic shift in how capital is formed and allocated globally. It reflects a fundamental redesign of the plumbing of global finance, with powerful, albeit often anonymous, entities now acting as the gatekeepers of capital. But as this new financial architecture takes shape, what are the diverging experiences and concerns for institutions and everyday consumers?
Institutional players, particularly pension funds, endowments, and sovereign wealth funds, view private credit as a cornerstone of their long-term investment strategies. Their fiduciary duty is to generate stable, predictable returns over decades to meet future obligations, and private credit's higher yields and lower volatility fit this mandate perfectly. They are deploying capital into specialized funds managed by firms like Ares, Blackstone, or KKR, which possess deep expertise in sourcing and structuring complex private loans. These large institutional investors often participate in multi-billion-dollar direct lending platforms that offer debt solutions across a spectrum of industries and geographies. The scale of their commitment underscores their confidence in the asset class, despite its inherent illiquidity.
The regulatory apparatus, however, struggles to keep pace with this rapidly evolving financial landscape. Unlike banks, which are subject to stringent oversight and capital requirements, many private credit funds fall into a less defined regulatory space. How does one manage systemic risk when a significant portion of corporate debt is held by entities operating outside traditional banking prudential frameworks?
The systemic risk concerns surrounding private credit are multifaceted and complex. A primary worry is the opacity of the market. Without clear, standardized reporting, regulators lack a comprehensive view of aggregate exposure, leverage, and potential contagion risks. Many private credit loans are covenant-light, meaning they come with fewer protections for lenders, potentially exacerbating losses in an economic downturn. Furthermore, leverage exists within the private credit funds themselves through subscription lines of credit or repurchase agreements, amplifying potential losses. If a large number of privately indebted companies were to default simultaneously, the ripple effects could spill over into the broader financial system, impacting even traditional banks through indirect exposures. To consider the hypothetical scenario of a synchronized downturn across multiple sectors, leading to widespread defaults in private credit portfolios. The valuation uncertainty alone could trigger a freeze in other credit markets.
While indirect, the consumer implications of this shift can be profound, impacting job security and the cost of goods and services. Companies financed through highly leveraged private debt, particularly in private equity-backed leveraged buyouts, are often pressured to cut costs aggressively to service that debt. This pressure can lead to layoffs, reduced wages, or diminished product quality, all of which directly affect consumers. Imagine a national retail chain struggling with sales, taken private by a firm using significant private credit. The intense focus on debt repayment might lead to store closures and job losses in local communities. Moreover, if financing costs for businesses are higher due to private credit's premium, these costs could eventually be passed on to consumers in the form of higher prices.
We are witnessing a fundamental divergence. Institutional investors flock to private credit for yield and diversification, while regulators grapple with oversight. As consumers, meanwhile, often experience the downstream effects without understanding the intricate financial mechanisms at play. So what does this mean for the road ahead? What macro projections can we make for this burgeoning market? And what potential futures await?
Regulators globally are indeed beginning to recognize the growing systemic importance of private credit. Discussions are underway at institutions like the Financial Stability Board and various central banks to develop new frameworks for monitoring and potentially supervising this sector. However, it is a complex balancing act. Overregulation could stifle a valuable source of capital for businesses, while underregulation risks systemic instability. Jurisdictions like Europe are exploring new reporting requirements, but achieving global harmonization for such a diverse and decentralized market remains a significant challenge. We are likely to see a gradual tightening of information requirements rather than a sweeping, bank-like regulatory overhaul.
Looking forward, we can project continued growth and consolidation within the private credit market. Larger asset managers will continue to expand their direct lending platforms, and we may see the emergence of more standardized products to attract a broader investor base. However, the market faces significant stress tests, particularly in environments of persistently high interest rates or a prolonged economic downturn. Valuation methodologies for illiquid assets will come under intense scrutiny, and the true extent of hidden leverage will be revealed. A major default by a large corporate borrower, heavily financed by multiple private credit funds, could trigger a significant repricing event across the entire asset class. The correlation of private debt performance across different funds and strategies, often assumed to be low, could spike during periods of stress.
The long-term impact on economic inequality and access to capital for truly innovative, smaller ventures is a critical consideration. While private credit serves mid-market and private equity-backed companies well, it may inadvertently favor larger, more established borrowers over nascent startups that genuinely need flexible, growth-oriented capital. If significant capital is channeled into highly leveraged buyouts rather than productive, job-creating innovation, it could exacerbate wealth disparities. The shift risks creating a two-tiered economy where well-connected, larger enterprises have abundant access to capital, while smaller, independent businesses struggle. This could stifle entrepreneurship and reduce the dynamism essential for broader economic prosperity.
Is private credit a necessary, efficient evolution of financial markets, adapting to new economic realities? Or is it a ticking time bomb, accumulating hidden risks that could one day destabilize the global financial system? The answer remains elusive, shrouded in the very opacity that defines this powerful, yet unseen financial architecture. One thing is certain: understanding these unseen architects is paramount to navigating the complexities of our modern economy.
The critical imperative moving forward is for greater transparency and data collection within the private credit sector. Regulators and market participants need a clearer, more holistic view of exposures and interconnections. Only with better information can accurate risk assessments be made and appropriate safeguards implemented.
Indeed, central banks and financial stability boards are increasingly focused on improving data aggregation and analytical tools for non-bank financial intermediation. The conversation is not about dismantling private credit, but about integrating it safely into the broader financial ecosystem. It's about finding the balance between innovation and systemic resilience.